Welcome back to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business using data. I'm Aaron Norris, along with Sean O'Toole of PropertyRadar, and this is episode 37. Today we have Sean Walker. This week we cover a lot of different topics, from tax liens to land banking to small villages of tiny homes. Sean has been in the industry for over 20 years and has used data in very creative ways to make deals happen at all different times of the market, often very contrarian. You won't want to miss this week. Welcome back to the Data Driven Real Estate Podcast. Today, we are very fortunate to have Sean Walker. Sean, thank you for joining us on the program.
Thanks, Aaron.
What keeps you really excited about real estate in 2021?
Well, you see a lot of different economists out there, especially ones that are in the real estate industry, whether they're with the National Association of Realtors that paint a sunny picture no matter what the market's doing. And there's a lot of different data out there to track. But quite frankly, I think we have another tsunami coming. I don't think we can avoid it at this point. I don't think a lot of those small businesses are coming back for people to, once they come out of forbearance. The investors and the secondary market are going to say foreclose. They won't have a choice financially. They can't keep stringing it out forever. So I think there's a lot of opportunities. And I know a lot of the big hedge funds, the Invitation Homes out there, they're saving up their dry powder to hit the market. I mean, I think for the individual investor, it's time to really get your ducks in a row, gather your financial resources, and start building capital, whether that's private investor partners or whatever resources you have available, and make sure you have good, clean data going into this next wave. So you are ahead of the pack on that hunt, if that makes sense.
All right.
I want to back up just a tad. I flew out to your offices in Utah, and I was on Andrew Cordell's Money Is show, which is in the same building, and was really impressed by all the different things your company has going on, and there's clearly an education component. You're a prolific podcaster and or I guess really webinar host, maybe is a better way to put that. And then just lots of interesting projects, from tiny home developments to all kinds of stuff. And then you have this incredible background of tax sale liens and single family home and land development deals and the rest. Just walk us through what you're doing today. And Aaron does provide a background, but I want to just talk about it a little bit.
Oh yeah, no, thanks. My background, I kind of fell into real estate investing. I started a little mortgage company with a good friend of mine. We quit our corporate jobs in 98. And we just started a little mortgage company. We just figured it out. And that's back before they had the current licensing requirements that they have now. So it's pretty easy to get involved back then. But we were professionals. We learned the trade and the craft and built up that client base. And in the client base, we started noticing that there were people that would just get in trouble. People that would, lose their jobs, or there'd be divorce. There'd be people that would need to get relocated for their job. And we were just referring all that business out to our realtor friends, saying, oh, here's a few realtors that may help you liquidate your property and help you relocate to your new market. And about, 3 or 4 years into the business, that had been our standard practice. But one of our clients who had been divorced had said, you know what, I've met with your realtor friend that you sent over. She called back a few days later, and he wants me to do all this fix up. I'm a single mom with 3 kids under 10. I'm getting remarried. I can't do it. And she goes, why don't you and your partner just buy my house and make a nice little rental? And she started telling us how much we could make with the rental, right? She's like, there's a lot of nice rentals in this area. It's very clean. The house isn't very trashed. I mean, the kids have been hard on the paint. The carpet's got to go. But I'll just give it to you.
Make money off me.
Yeah, and she didn't want to go into the new marriage with any debt or an obligation of a payment with her new husband, which I thought was admirable. So she wasn't looking for a sugar daddy per se. But she goes, well, I'll just give it to you for what I owe on it. And so I was kind of patronizing, to be honest with you. I just said, "Oh, that's nice. Well, let us consider that." And the first time I'd ever thought about investing in real estate for myself, other than my personal property. And so I hung up the phone. I looked over at my partner, who sat about 10 feet away from me. And I said, "Hey, do you want to buy a rental property?" And he goes, "I don't know. Can we make any money?" And I said, "I don't know." But what we were good with was math in spreadsheets. And we used to run amortization schedules for our clients. And even if they prepaid it a little bit, they could pay it off early and then reinvest back into the market. And so we ran an amortization schedule with somebody else paying the rents. And their labor, we thought, wow, this is great because we're not having to work 40 hours a week to pay this rent payment. This is a nice way to leverage our time. Because we knew with our little mortgage business that we only had so many hours in the day. And we'd already capped that out after about 3 or 4 years. We just couldn't work any more hours in the day to keep growing our income unless we wanted to go with more of a brokerage model. But then you've got employees and the hassle and all that fun stuff. And so this was kind of like a huge light bulb went off for us. Then we found out that we ran out of capital very, very quickly. Because you have to put a down payment for so we started flipping some houses to get capital to buy another rental. Our goal was to have 10 rentals, and that would be our retirement, and have some residual income in case one of us got hurt or something like that. And that was it. That's the whole start. And then in around 2005, we started looking for other passive ways to generate income, and that's when I came across tax lien certificate. And there's certificates, and there's a huge dearth of information about there that's false. Just what do you want to call it? Fake news. And it was all get rich quick gimmickry. So I bought a book that just gave me a list of all the counties that sold tax lien certificates. And I kind of ignored all the tips on getting rich overnight stuff. And I just started calling the counties and doing my own research. And so we started investing. We've created 2 funds for our tax lien portfolio that have done very well over the years.
How many tax liens have you done?
Roughly about 3,500.
Wow.
And that's a $30+ million portfolio that we built out. There's 2 separate portfolios. One that was leveraged. So we worked with a bank, B of I Federal out of San Diego, and had a credit line. A $15 million credit line for that one. And then the other one was a cash and partner portfolio that we built up.
Wow.
And then, yeah, sorry.
Yeah, so let's just talk about that really quickly. So data, right, is
it's huge.
Is an important part of that. And,
Yep.
This is a data-driven real estate podcast, so I always come back to data. And so talk to me. Was it hard to, find data and to do that business?
It's super data intense with tax liens, because what you're not just going out and looking at a handful of properties on a Saturday afternoon on a drive-by, because at scale, when an auction's coming up, you might be bidding on 300, 400, 500 houses, but based on competition, you might end up getting 20% of what you bid on, but you still have to scrub all that data. So literally with the county, you would download an Excel spreadsheet. Some counties, you didn't even have that. It was in a newspaper or a PDF when we first started. And then we'd have to convert it into, try to get clean data into a spreadsheet. But the boots on the ground,
and that data is just, hey, there's a property going to tax sale. It doesn't give you any information about the property. And
I might just have a parcel ID and a truncated legal description without a property address even.
Wow. So you even had to go do the research to find the address before you could even say, is this thing worth bidding on?
That's exactly right. And then we'd have to sort, sift, and filter by property type. When we get the master bulk list from the pre-auction data from the county, we didn't want to do anything other than single family residential and vacant developed lots or building lots. We didn't want to do commercial. It was outside. We didn't want to do raw land per se. We didn't want to do anything that we didn't really know about, because if you buy a tax lien certificate, you could eventually end up with that property. And so it's just scrubbing the property types was, a major thing as well. And it never really got easier.
That was really eye-opening for me when I first started doing some tax deals, was like how many of there's like parcels where there's like off ramp and stuff, and it ended up with this little piece of dirt that's like
a
a
1,000-foot fiber optic strip or
Yeah.
an easement strip that nobody wants to ever buy. And we made some mistakes. I will tell you, not having the right data. Here's a classic mistake. I can't make this story up. So this is how important getting good data is. We saw 13 acres come up, and the taxes were about $2,500 to buy the tax lien certificate, what the principal amount owing was at the time, right? And so we thought, man, that's a great deal. And so we didn't really see what type of property it was. And so we purchased that tax lien certificate on the 13 acres. This is in Central Florida. Come to find out, and even this is the early days, so don't judge me too harshly, Sean, on this, but we even took it to foreclosure, which was a few thousand more. And we had some builder contacts in the area and things like that. We thought, gosh, this would be a great, possibly to wholesale it to them or joint venture on this 13 acres. Well, the first person that we took it to, once we got the deed, they said, this is on a power line strip, right? And we're like, we had maybe 5,000-6,000 into this so far. And we're like, oh, and then we pulled up the Google map, the imagery. Oh, so it was a total goof up. And again,
the whole thing is just a power line easement, completely unusable.
And when and the thing is with the Google overhead view, it wasn't readily available because there's a lot of trees and woods and stuff like that. It was really hard to see what exactly it was unless you were local. So a couple key lessons there: do your boots on the ground. Number two, make sure you have really clean data, because had we had better data, we would have easily seen that. Now, we got bailed out on that one. I can't make this up. We got approached with a letter, a llama farmer that had an adjoining llama farm right next to it reached out to us and asked if he could lease it out on an annual basis to let his llama graze. And we said, yeah, go knock yourself out.
So you still own it, and you're still
he pays us $750 a year. So we might break even. I don't know, by the time I retire. I don't know. So, but again, I'm not saying that's a great scenario, but the data is key. If I'm giving a huge plug for data here. Yep.
So that's an interesting one where, you were thinking maybe it was a little subdivision or something, and you went on to do a lot of land and subdivision deals. Is this a good segue into that maybe?
Yeah, we did. We at first in our acquisition model, we did start buying at auctions. So two different acquisitions models that we had.
One was judicial foreclosure auctions.
Yeah, and we primarily focused in Florida, Arizona, and Nevada. Okay, and so we had two focuses on our single family residential portfolio at first, which was Arizona and Las Vegas area, if you will, metropolitan statistical area. So that was our main push at first for single family residential. And then and also the tax lien certificates that we were buying in Arizona and in Florida at first were only on SFR product. We didn't look at any building lots or anything like that, even though there's a ton of those in Arizona, where the last recession, the builders just went belly up.
Yeah.
And they left all these vacant developed lots. Some of them were entitled, some of them weren't. Some of them were stubbed in utilities, some of them weren't. And so what I started seeing is I said, man, if the building market ever comes back, I can get these lots dirt cheap, like $1,500 for something that traded out in the marketplace in 2005 for $35,000. And I can get it for $1,500. I can clean the title with a quiet title action for maybe another $2,000 and then land bank it. Or I can resell that on a seller finance deal to a retiree couple, which we did about 2,200 of those. We put those out. And
2,200 lots you resold to people who wanted to build.
Yes, but they did a payment plan with us. So they'd put $500 down and pay us $75 a month or whatever. And they did multiple years. So we did a bunch of that seller finance. That's a common technique with just kind of mom and pop land bankers. You see that quite a bit.
So they're buying a lot to build their future retirement home, but not right now, maybe in 10 years or something.
That's right. And then in our Vegas, Arizona markets, especially, we were hitting the auctions as soon as that inventory started to free up. And this was more around that 2012 mark, because a lot of stuff was locked down. If you remember Vegas, there was a judge that slapped around the bank saying, hey, you don't have the original ink. You can't foreclose. So a lot of that stuff was stalled up in courts, and I don't know what eventually happened to all that stuff. But when the inventory started to flow, we built our portfolio in Vegas, and I will tell you, it was a nightmare because we were doing a lot of short sale offers, of course. But with the auctions, you would hear about stuff coming available for auction, and we literally had drivers. If I would have had better data, again, another big plug for data here, it would have saved us so much time and expense because our drivers would drive throughout the night, and some of these weren't the greatest neighborhoods either.
Okay. Yeah, you know, PropertyRadar was in Vegas when you were there, but you were an East Coast guy. And we were a West Coast company, and you never saw it. I think it blew your mind when I gave you a demo of what you could have had that whole time in Vegas.
It would have put a lot more money into our bottom line because there's a lot of those properties we wouldn't have chased in the first place, or even attempted to bid on. And so it was like the Three Stooges running around, and then our guys would go out and they'd be driving all over Vegas on these properties that were coming up to auction. And sometimes that data would come in last minute, and sometimes it was wrong. Meaning they would get the properties confused based on a drive-by. It was dark when they drove by. And we were scrambling against other investors and other big investors that were, Wall Street was starting to take notice, right, of this marketplace, of the SFR marketplace. So I remember specifically, we had one property that ended up being not in the right neighborhoods, okay, for sure. And it was completely overtaken by the homeless. And there was a bunch of chickens in the back. We ended up buying this property. And so as a joke, and everybody blamed me, I was really the end call to say bid, and here's the top bid on some of this stuff, on a big chunk of it anyway. And so we were down in Vegas doing boots on the ground just because we go down almost once a month. And some of the guys were getting me back. And so they took one of the chickens from the backyard and put it in my hotel room in a box. So when I came, and so that was revenge for not having good data. We bought a property. Now we just kept it as a rental forever. In real estate, time heals all wounds, it feels like. And so we sold it in about late 2017. But
you bought a lot of building lots, maybe even entire subdivisions in Florida too, right?
Well, yeah. Most of the time we did it in what's called a scattered lot subdivision in Florida. Florida is very unique in the fact that you have retirees migrating from each decade, no matter what. And so on a singular street, you'll have a house built in the 50s, 60s, 70s, 80s, 90s, one from 10 years ago, and a brand new build right next to it.
So every decade, new groups coming in, and
and I'd hate to be an appraiser. I've mentioned that before in the state of Florida. It's interesting though,
Aaron,
because
no, I'm laughing. As you drive down the streets too, you can tell the decade because of builder code, the elevation of the house.
That's right. Because they have
some
to
houses
elevate.
are down here and some are up here.
Right next door, you could have a 4-foot difference. I'm not kidding. It's so
that's right.
Like 1990. 2010.
That's exactly right. And it's so interesting to see that. And then another big thing for us in the Florida market was I went to Urban Land Institute conference, I think it was in Tampa in 2015. And they were starting to talk about boomers, retirement, birth years, and when they were going to start peaking. And so 2016 was the peak for a 10-year period for boomers retiring. And we thought, let's compile more lots, because we had started a couple of years with tax lien certificates, but we weren't getting a ton just from buying tax lien certificates. It's a great methodology. But what we then did is we worked with some local agents, and then we started doing our campaigns out to out-of-state owners. So we would send out mailers and postcards. And if it was a couple in Arizona that owned a lot in Florida, or a couple up in Arkansas, and if there was a singular name on the lot ownership and they lived out of state, those were the ones that we hit first, because we figured the other spouse had potentially passed away. And we were getting people just selling us their lots for very, very low prices because they didn't want to keep paying the property tax on those.
Well, and I want to give some history, so because you and I both know the area that you're building in Southwest
Yeah.
Florida, where you're getting these lots. In 1960, these brothers from New York came down, and this area has been made popular by Thomas Edison. Actually, Edison, Firestone, and Ford used to have their winter homes down there.
Yep.
And then Cape Coral is just slightly north of Fort Myers. And there's literally, they were bringing in people from New York. They put them in a plane and you would drop a sandbag, and wherever your sandbag dropped is where your lot was. And they built out this infrastructure. I don't even know how you do today. Cape Coral is a huge area.
Yeah.
And you've got all these canals. Some go to the Gulf, some are fresh water. If you don't know what you're looking at, it's extremely risky. On top of that, you also have environmental problems. You've got tortoises, burrowing owls. When I first went through there, I thought a whole bunch of people had gotten murdered on the side of the road because of little.
You're talking about the environmentalists. So I'm not making fun of environmentalists, but they are religious, almost cultish, right?
I mean, some of this data lives in public records, but you can't bid on stuff. Like, you really have to understand the nuance down there. And how did you plug in?
Well, again, the data that we would do, we got so desperate for good data that I had my son, who was in college at the time for software engineering. He wrote a macro to scrape the data from the county sites, from Lee County and Sarasota and a few others. Some were easier to do than others. And so literally he'd write a macro. We get this data, but it wasn't pure. It wasn't clean. And so that was a major challenge. Again, we would do our drive-bys. Yeah, we would spend a lot of time boots on the ground, but that, again, getting the data in advance before you do that, it would have saved us 50% of our drive-by times. And I went street by street in these areas because we had investors investing with us. I felt it was my obligation to know every single area and street and take notes, and we did. Having a drive-by app, and I'm cheap. I'm giving you a cheap plug here, Sean, but you guys have some amazing features for that, right? On the drive-by stuff. And
it's so funny. You get new folks and they just expect all this stuff to be right at their fingertips and all the rest. And they have no idea how hard this business was just 5, 10, 15 years ago, not that long ago. And like how much it's changed and how much more data is available. It's crazy.
Sean, I'm going to really date myself because I know we're roughly about the same age, right?
Yeah.
Okay. So in the late 90s, early 2000s, when we had just first started our mortgage company, I would have even used your product for mortgages back then if I had it, just to get more details about the house, right? Because we were running, do they have enough room to refinance? Is there enough equity? Because I would pull public records off microfiche, okay? I was pulling notice of defaults. I would pull anybody that had any change in a conveyance per se. Or any new liens that had come on. So I'd look for somebody that maybe had just purchased their home. And then after about 12 months or so, after they had absorbed some of those initial costs, I'd hit them up for a refinance on a little marketing campaign. But I literally had to go to microfiche. I have my big notepad there. Every Friday morning from 9 to 12, I would go there. And I'd see all the other schlups down there just like me it was mostly realtors trying to harvest for leads. And then you hit the notice of default list. And then we'd say, hey, you don't have to lose your house. Let's do a subprime refinance for you. But we didn't do a lot of those because it really put him in such a bad interest rate and loan scenario. And, in 2 years, it was going to start jacking up the rate. So we got away from that eventually. But then it was like a miracle. Early 2000s, a lot of the title companies had technology to at least scrape data from the counties. And they could print a list for you.
Yeah.
And so Friday mornings was a mad scramble to go pick up the physical list from the title companies. Okay.
Everybody trying to get the list first. Yeah.
But it was a paper list. So you're still sitting there. And I can remember when I first became an investor, I would go hit the FSBOs and I'd buy the freaking newspaper with my highlighter. And I mean, if I've got an app or whatever it is on my phone, as I'm doing my drive-bys, especially, this is like gold, and people don't get how valuable this is. If you're an active real estate investor, you'll waste so much time not having the right data at your fingertips before you even make those offers, before you hit the streets, even to do your driving for dollars. I've heard is a technique, right?
Big one, especially with our app, because we show every property as you're driving down the street, and equity and foreclosure and all those things. And then you just, oh, that one's interesting. You press tap and up pops all the information. You can even call the owner.
Well, and a lot of times what I'm looking for as I'm driving around, if I would have had the app, especially when we are driving on our lots, if I would have seen a business holding a vacant lot that had an out-of-state address, I'm like, oh, I'm going to jump on that. A single person holding an out-of-state, or on our houses when we were driving around, if I already knew a hedge fund owned it, I'm not going to bid on that, or you know what I'm saying? So there were so many applications. If you had that data, if it was held in trust and it was out of state, a couple different things happen, meaning it was an inherited property, or some kids now own that trust and the mailing address is going to them out of state, but the subject property is in Florida, for example, or Arizona, where the grandparents or whoever, the parents, had lived for their retirement. So that would be one that would trigger immediate activity for me. If it's an out-of-state rental from somebody that's inherited a property, well, eventually they might get a nasty eviction. It's that moment in time. I want them to call me first. And if I had that information just on a drive-by, it's like literally having X-ray goggles as you're driving by.
I like that. X-ray.
Yeah.
X-ray goggles.
Because we can see what's happening with the family immediately. We see trust, mailing address, out of state. And that tells me so much about what's going on with that scenario. It's going to trigger as a high quality, high activity lead that I got to jump on faster than the rest of the houses on the street, for example.
And we're now at that point where it's just, those are just criteria, right?
Yep,
I want the individuals, I want the out-of-state mailing addresses, and show me all of those for all of Florida, right? Like it's super easy now. And it's unbelievable how hard it was a few years ago.
Yeah, one of the cool things too is that with the data, we had particular investors that would be attracted to us. Some of them would look us up on public record.
They'd see how many deals you're doing. Yeah,
and on the land, we had builders looking us up. So there's Adams Homes, there's Lennar down in the Florida area, there's D.R. Horton. There's quite a few small to mid-sized builders as well, but those are some of the big fish down there. And so we had D.R. Horton just reach out to us, and they wanted to pick up 80 of our lots that we had acquired through our acquisitions channel. And we made a very reasonable deal with them in bulk, and it worked out well. Part of the reason is I also wanted to have an outlet to sell in the future, or if there was any possible joint venture potential on building. For example, now they won't, D.R. Horton won't do it. They want all the money. Okay. I get it. But we have done joint venture builds with builders where we had the underlying collateral of the lot. It met all their criteria as well. And so, when you can actually compile inventory that other investors like, that starts to attract them to you, because they're doing their research online as well. And they'll say, oh, this company owns these 20 pieces. Let's reach out to them. And it's even more surprising that D.R. Horton even hit us up, because we bought tax lien certificates on a bunch of their subdivisions up north, because they're all over the state. They've got about 30 locations in the state of Florida. And what the developers did after the last recession, which I suspect may happen again here soon, is they stopped paying the taxes. And they would wait till the very last month before they were going to get foreclosed out and pay just enough to get foreclosed, because they were all juggling cash after the last recession. So they owed us $560,000 on a whole subdivision. And we were going to take the whole thing down and sit on it, because they had already put the roads in. They had nice entrance area, and they wouldn't deal. Their attorneys out of Texas wouldn't deal with us. And we said, okay, click. And they knew we were going to take it to auction. So literally a couple of days before the auction, they sent us the check with interest, and they tried to bargain with us on the interest. The attorneys did. And we said, no, click, because it's all state statute.
Right.
So it's, as you get the right types of inventory for that market, it's really key, because you need to look at days on market per price range as well. So there'll be certain price ranges that are the hottest spot within that market on price range, right? Might be
other things will sit.
Yeah, other things will sit, or the high-end stuff has longer days on market, but your flippers, your rehabbers, they're going to be looking for stuff that can turn over the fastest. So if you have the right data and you've got this list of investors that, you can work with, partner with, or maybe even wholesale to, some people wholesale this stuff. It's a great tool to then only focus on the hottest selling, lowest days on market types of inventory, and sort by bedrooms, baths. Okay. And then gauge that, which is it 3 ones that are selling the hottest? Is it 4 twos? And then look at days on market, and then even just break that down by subdivision, zip code, and only focus on buying in those areas, because everybody else that's tracking the data as well, the real professionals, they're going to see you buying in their area as well. And when you get something they want, it's a really nice relationship that you can build.
I want to make sure people appreciate sort of the data aspect of what you're talking about in this area. I've seen the land cost at one point during the peak of the market. Some of these things were going for 90 to 100 grand, and then they went under 10,000.
That's right.
What
on the lead up to 2007, and a lot of European buyers were coming in paying crazy prices on a quarter-acre lot. They're kind of
what data were you looking at saying, you know what, this looks like a good idea, because at that moment in time, you don't have a lot of competition because people are scared. They're licking their wounds from going from 100 grand to 10 grand. And you're like, I'll take some of that. And then just hold the world together for the next 5 years, and I'm good with that.
Yeah, it was 2 phases of our operation, meaning when we first went into Fort Myers, Cape Coral, we were focusing on short sales and flipping and keeping rentals. Okay. And so when we would flip, we would take some of that money, get another rental, or a portion of those funds, and put it towards tax lien certificates, but we'd only do it with profit. So if I'm going to hold land, that needs to come from net profit after paying taxes and overhead on a flip or something like that. Then we would take a portion of that and acquire tax lien certificates, or maybe buy some lots. And we figured if we can have enough to hold this lot for at least 5 years, we think the market may come back by then, but it was a gamble. And so we had to kind of juggle the cash flow, because you can't just go out, even when the market's down, and acquire stuff that's not bringing in income and expect that you can just sit on it forever. So you got to have some cash flow coming in. And with those proceeds, don't go buy a new Porsche. Get with a good tax accountant, pay your taxes, make sure you have enough operating expenses to run your business, but take the surplus and reinvest in a very desperate or low market to control the inventory.
Because I mean, this is a market that's been around since 1960. And so you're often talking to people maybe who have inherited this 2 generations back, and they have no personal connection to it. And it has its ups and it has its downs. So I was just curious about that.
Well, our main focus was migration patterns. That was my main focus, because in certain areas of the country, we were looking for areas where the data showed us that if we acquired a property, we could successfully cash flow it with at least about a 4 to 6% cap rate, or we could flip it with a reasonable flip if we made that choice. So we were looking for data that would support optional markets. And you take a town like Northport right now, crunch the numbers, it still works in a town like Northport. Cape Coral starting to squeak up a bit more on that, but that's the type of markets we were targeting. Go ahead.
I want to focus on that for a second, because a lot of people go, oh, 4 to 6 cap rate, that's not very good.
Right.
But what that is that's your safety net.
Yep.
Right. So, and this is something I actually think is like really important for like the real estate market at large, and like lending and all the rest. Right. So if you think about loans in 2005, when prices were so high, right? Like in California, you were getting down into 1 and 2 cap rate, right? And so if the lender's taking back that product and they have to rent it out, they're getting a return that's less than treasuries. And it doesn't really make a lot of sense to me to be making loans into that market really at all. Like
that's right.
By 2005, we should have pretty much stopped lending unless you were putting 50% down. Instead, at that point in time, we had the pulse loan, where anybody with a pulse could get a loan, right?
Yeah, social security number and pulse, and maybe it even wasn't your social security number.
Then jump forward to 2009. I know the California number is better. 2009, right? You've got houses that are 15, 20% returns on investment, right? And the banks won't make loans. Yeah. And of course, smart investors like you go, whether I flip it or keep it or whatever, it's fine. And I think a lot of our investors would go, a 4 to 6% return isn't very good, what you just said. But I love that you said, okay, we're going to buy assets that have this return. If something goes wrong and we get stuck with it, it's better than treasuries. It provides a return on that capital. We're not going to lose money, right? And on the other side, there's a flip potential here where we can make a profit. So now you've got you've got a backup strategy. And that's how I think you can really, I think it's just such an important point. And it's just, you just glossed over it, but it's such an important point because you gave yourself a backup strategy that if something did go wrong, you still have income and you still got an okay return. It's not a great return. It's not the rental portfolio you'd want to build, but it's a great backup.
Yeah, I thank you, Sean. I mean, there's some great points. We're overly simplistic anymore, meaning we don't even compare this. If anybody's comparing this to what your stockbroker's telling you, or, the latest crypto craze or whatever it is, I get that. I just don't understand those types of investments that aren't backed by collateral. And maybe that in some circles, or some of my golf buddies would say, oh, well, this, you're not doing the new sexy thing. And I'm like, yeah, whether or not you believe we were created, or Adam and Eve, ever since man has come to be in this modern age, whatever you think that is, and they got booted out of the Garden of Eden and needed a place to keep the rain off their head, that will never go away. I don't care what the assessor says about the value of my property. I don't care. I hope they're all zero so I don't have to pay property taxes, right? I don't care what a realtor thinks or an appraiser thinks. I don't care if the cap rate's zero, honestly, at the end of the day. Now, yeah, we like to make money, but at the end of the day, if the market crashes, I can still rent that property out and push along. That was our whole goal when we acquired then, was to get a hold of the asset. And when we looked at the statistics since roughly 1990, well, and you can look back, there's Case-Shiller and all these indexes, and you see these different time periods where there's been a recession. Real estate has just done this, but it's continued. So if you bought a house, right, if you bought the same house in 1990 in Cape Coral, you're probably 75,000. Today, that's going to trade in the upper 280 range if it's in pretty good shape. Brand new properties are trading in the 330 range. They're a nice fixed up 3-bedroom, 2-bath, 1,600 to 1,800 square foot property in Cape Coral. That same exact property is going to sell for 75 to 100,000 in 1990. What's it selling for today? So we know, looking at the history of real estate, and you think back to, well, the stock market, that's way up here. But how come your portfolio of a couple 100,000 you started with in 2011 hasn't gone up 15-fold like the stock market has? You're still sitting roughly maybe 280. Why? Because you've been traded out so many freaking times, because that's how they make their money, is by turnover of your money, not the growth of your money in general. Now, I'm oversimplifying that.
Not only that, in the stock market, you don't have a tenant, right, paying down the money that you borrowed to buy the asset in the meantime, right? So not only is it the appreciation there, but you've got a tenant and income. And if that income's not coming to you, it's going to paying down the, maybe the debt you used to acquire it. So, it is quite different. So I'm not going to sell you on the my latest non-fungible token idea. And
there are some cool things that could be in just on the moving money. So I think the technology is amazing. As an investment vehicle, I don't get it. Here's what we focus on as well is, I don't feel sorry for anybody that loses money in the stock market, because it's 100% out of your control. As much research as you're going to do, you have zero control of what happens to that investment, and it can go to zero. You have no recourse to get your money back. Once that money's gone, it's gone. With real estate, you make your money on the buy side. So if you screw up and buy in a bad neighborhood, you have the wrong data, and you buy the wrong property, then it's going to be a long struggle, but it's still real estate. Maybe 20 years from now, you get out of, finally make up for it. But you still have some collateral there. And if the market tanks and the value of my property goes from 200,000 down to 100,000, I haven't realize that loss, and I can still rent it out, and I still have the opportunity for that piece of real estate to bounce back. But at the end of the day, the utilitarian use of that asset will never change, meaning keeps the rain off our head. And it's really that data when you go in for the buy, whether it's auctions, whether or not you're doing some marketing campaigns, the integrity of that data is everything, because you're making buying decisions off of that data. And it's been,
that's what we do.
Yes. Yeah. And until the last several years, it's been until the last several years, it's, and getting high-speed internet, broadband plus speeds and fiber, Google Fiber speeds, makes a huge difference as well for providers like you and the consumers on our end, the investor end, to really get access to everything a lot faster.
Let me ask, let's jump on that. Are you paying attention? You mentioned, data access, and I think that's about to change maybe some home values with Starlink and low Earth orbit satellites. Are you following that at all, and what that might do for rural areas?
But I want to follow that. Yeah.
That's cool. That's an interesting one. So,
well, you got a lot of
mentioned
big players.
it, so I thought maybe there was a segue there.
No, and I want to talk about, companies like Zillow, that we kind of laughed at in 2007, but what do they really have at their fingertips? They're tapping into, the Division of Real Estates, the National Association of Realtors just rolled over and just said, oh, here's all our data, without thinking about the long-term consequences that companies like Zillow and their platforms would just put them out of business. And they're doing it.
I don't know that they rolled over. I think the FTC had a lot to say about.
Well, I know. But it feels like and I'm a licensed agent as well. It feels like you pay it all these funds and no representation. I don't think, but it's because they have access and they've gathered this user data and data from the counties for years and years and years that they have at their fingertips now. And some might say, well, they got lucky or they're so big, but they weren't that big to begin with. The difference is, to me, if we're kind of comparing what these large outfits have done in the real estate space to us as individuals, the difference is they went after the data, and now they control it. And realtors have to pay homage to Zillow if they want to get leads, pretty much. And it's mostly buyers' leads, because Zillow has all the data and all the leads. On
the buyer's side, I agree. On the seller's side, they should use us, but on the buyer's side.
That's right. That's right.
Now, you're based out of Utah, correct?
Yes.
So we've mentioned several markets, but none of them Utah. Utah has real estate the last time I checked. So can we talk a little bit about why not Utah and the data that you're using to select the states that you're in?
Well, and we look for markets where we can purchase and potentially, and that's getting harder and harder, obviously, unless you go really rural, or you can potentially rent it out or flip it. Utah was, I would say, 2015 to where it kind of hit that benchmark criteria, that inflection point, if you will, to where that became difficult. A lot of it is because in my area, we have two major universities. And so there's a lot of rent control. And coming from California, Sean, you might be able to relate to that. So what we did is we focused on commercial. So we've put together a good sized commercial portfolio here with warehouse, some retail, and apartment. And that's been our push in a market like this.
You guys have some beautiful apartment projects. It's really stunning.
Yeah, it's been fun. And but SFR is really, at the end of the day, single family residential is really the core element, I think, of what is long-term success. And commercial, the A-class commercial right now, Class A commercial, is just taking a beating.
I know you're part of a larger company, a lot of stuff going on. So I don't know if you were involved. Are you involved in the tiny home project?
So that's
going at all. Can you talk to that?
Yeah, exactly. So again, I think if you look back at this kind of movement, if you will, it really kind of started in the 60s. I know it sounds terrible, but think about this kind of free spirit that's come back around, and of not being tied down. And I mean, really, it started in the 60s, but it was in a Volkswagen bus or or an encampment somewhere or something like that.
Now it's in a $130,000 Sprinter.
Exactly, with the Mercedes symbol on the front. And so
Exactly.
But the fact that some tiny homes you can relocate is wonderful. Now, our project's a little bit different in the fact that they're going to be attached, meaning to the ground, so they can get some more traditional type financing. Because if you still have an axle on something, the home lenders aren't going to touch it. Okay.
Right. It's personal property.
That's right. So it'd be considered chattels or like an RV luxury type loan that you're looking at there, which is crazy rates, right?
Yeah.
So, what we did is we got a city that would play ball with us and a county with the density level that we would need, how much density we could get per acre. And so, what we have is a massive, massive shortage of inventory right now. For example, my son, who's just turning 30, he wanted to get into his first townhome, but we did some auto hot sheets, the daily things that would give us notification of what townhomes would come, because that's the new starter home here because of price raise. But everything was gone within hours. So we went and got our data, our off-market data. And we found a guy that owned a townhome, and it was an individual. So there was just one name on title.
Yeah.
And I went back and looked at his history, and it used to be two names. So I thought either it's a divorce or he's widowed. And it turned out he was widowed. And he had his teenage son still living with him. But I caught him just at the right time to where he wanted to build for him and his son a house. And he had, and I could see his equity position as well. So I could see kind of what the current value was, because I knew that market, because I could see all the data. Yep. And I could see what he owed on the property, and he had been in his loan about 19 months. So I just ran a quick amortization schedule. And I thought, he's probably about right here on what he owes approximately. And so because I had that background and that data, reached out to him and I said, hey, are you even thinking about selling? Because we can do it all without an agent. My son's looking for a place. He's pre-qualified, and I can just set up the deal for you. And I've got some attorney referrals where you could have them analyze all the paperwork to make sure you're comfortable with it, and so forth and so on. And we caught him at the right time. Now you might have to send out hundreds of, postcards or something to get a hit like that, but we knew we had to go off market, and it was like a miracle.
That's 100% what's driving our business right now. Like it just there aren't listed properties. If you want to buy something and you want to get a reasonable deal, or you just want something that meets your criteria, period. Yeah. Even if you're willing to overpay, you have to go off market right now.
And getting the data like PropertyRadar has is really key for especially beginning investors. And here's why: because realtors aren't going to pay attention to you at first. Okay. They're just not. Even if you have a lot of cash, it won't matter because of the migration patterns, because you've got folks from California going out to Arizona with their cash. They'll sell their place in Cali. They'll roll in with 400,000 cash of equity, and that'll give them a nice property in Phoenix, for example. So even if you're a cash investor, doesn't matter now. You need to chase those off-market deals. And because there's a lot of real estate agents, because they do not want to list properties where there's tenants in there that aren't paying. Okay. They don't want to list properties that are maybe, yes. Or where there's somebody that's in hospice, but all the stuff is still there. The family doesn't have any money to get grandma's stuff out and stored, and or get the property fixed up to get retail. And the realtors don't want that inventory, but you as an investor can track it down off market, make arrangements with the family to help, all in the contract, of course, and find those deals. Because what we do know is there's never a shortage of human suffering that we can help out as an investor. I'm not putting down agents, but that's above their kind of mindset or duty in most cases to go.
Well, if they've got enough business without that, why do that work? Well, it's a good decision by the agent not to take on those hard projects, because they're going to spend a lot of time for not any more money. They got 2 listings for 400,000. This one's got a ton of work.
Well, and it sells day one.
It's the same commission.
Yeah, I think, to me, if I were a practicing agent, I have my license for my investing, but if I were a practicing agent, I would absolutely use PropertyRadar to get my listings, quite frankly, and then anyway.
Back to the tiny home. How big is that project, and how far along?
13 acres. And I think we have 8 units approved per acre.
Okay.
Yeah.
So about 100 units on 13 acres, 8
Yep.
units an acre.
Containers.
And
So we got to
what's
get
that?
those shipped over. It's a kind of a prefab container to where the insides, basically to an insulation level, are done. 1/4-inch sheetrock on those, kind of a veneer, if you will.
Okay.
And yeah, and they're stubbed out to a basic design parameter with what, in layman's terms, what holes are in the, access and so forth, for, power coming in and ventilation and all that sort of stuff. So it's kind of this template that we get, and then we build out the interior when it gets there.
Is that a
Oh,
lease
interesting.
project? A lease project, or are you selling those?
You know what? We thought about rent to own. And we've done that, but not with a product this expensive and all at once. So we've done lease to owns on a one-off basis, depending on the property scenario, but we haven't, and we did a lot of land, lease to own or rent to own on building lots, but those were small dollar amounts.
You're not holding these long-term as rentals.
Yeah, I don't think so. And I think that if we put these up, we're still kind of tinkering with our price, but kind of the low-end townhomes for about the same square footage are going for about $275 to $285. We're thinking about coming in about $230, $235 on these, but we haven't tested that marketing yet.
For a container home, how many square footage?
Oh gosh, we're 1,200. We got a 1,200-foot model. Well, we've got them down even smaller than that, but it'll probably be under 200,000. We're just going to kind of test and see what kind of marketing bounce back we get on this.
So 1,200 square feet doesn't really sound like a tiny home, but you're building them using containers. So it's like 300-400-foot containers connected.
Yes.
Is that kind of how it works?
There are some, it all depends. So we're going to have probably 2 or 3 different models. One is a stripped down model for sure. I mean, one is just get in, and we're probably going to start at about 160 for that. But honestly, we might not even do that, because we think even at the top model price that we'll just sell them right away. In financing, we're still kind of wondering about, I don't know if conventional banks are going to touch this yet. They might, but that's an issue as well that we're kind of working out. We've got non-conventional kind of A- paper types that will put in a big plug for like an RCN Capital. They're one of the larger private lenders out there in the space. But taking it down to Chase or Wells right now, I don't know yet.
It'd be tough.
Yeah.
Utah private lending, the last I checked, you're like 15% rate for hard money out there. You're known for being really hard.
Yeah, and it is a bit of a challenge, because even if they were to get in one of ours, even if they were with kind of A- paper lender at that 5 to 7% mark per se, that still cuts down the affordability, where they could just go get a townhome or condo at whatever the par rate of the day is on a 30-year fixed, and probably be around the same payment. So that is a bit of a struggle that we're working through right now. We could offer our own financing packages, and we're considering that. We just don't know if we want to have that much hanging out there at one time, maybe sell some and maybe finance the back end of the portfolio. We'll see.
I know we're coming up on a hard stop.
Yes.
Let's talk a little bit about, you have a webinar series now. I don't know, is that publicly available to anybody, or is that just for your guys' core folks, or how does that work?
Core investors. Yeah, it's for our core investors. We don't do anything on YouTube or out in the mainstream. We've just built up a group of investors over the years through various types of relationships or different investments that people have done with us over the years. And we put that out as just a way to, with our clients. And if you're an investor yourself, doing something, what Aaron and Sean is doing here is absolutely brilliant, because it keeps your people engaged with you, whether it's once a month or once a week. I would highly recommend doing it. And we were talking about the gear before we started. And it's not much, but if all you're doing as a new investor is just going on and talking about deals you're looking at, and if you're using, now, Sean, here you go. And Sean has not paid me to say this, you guys. If you're using PropertyRadar, one of the coolest things in the world is to do screen capture webinars with PropertyRadar to your investors, because it makes you look like you're a genius that's been doing this for 30 years. Because you can say, hey, look, we're going to break down the San Dimas area. I'm looking at these 3 zip codes. Let me pull up my absentee owner list here. Okay, I've got about 320 potentials here, but I really want to go with stuff that was built after 1970s. I don't want to get into the super older neighborhoods here. And I really want to get above about 1,500 square feet. So I know I can get at least 3 bedrooms, 2 baths. Because if I'm going to flip that thing, I need that square footage in those beds and baths to get max retail. And I also know that because a lot of our cash investors, that's what they're looking for. They don't want the teeny 800 square foot house in those older neighborhoods that crime might be a tad higher. So I'm going to push to this type of product for this type of investor. And I know I can move those out fairly quickly or find a partner right away for this type of product. So if that's how you're talking on the webinar with PropertyRadar, it's just going to attract that money to you, in my opinion.
Yeah.
Sorry.
If people want to follow you or learn more about you or learn more about your company or become, be an investor with you or that kind of thing, how do they find you?
LinkedIn is probably the best way. Yeah. Okay. And I was telling Aaron, I don't have much of a presence on YouTube or Facebook, and
it was hard to find you, but that's how I stumbled across your activity in Southwest Florida. I'm like, what are the chances? That is so weird.
Yeah, no,
I mean, this is a challenge. It's a challenge for us as a company, right? Because guys like you, they're out doing this kind of deals. Like, you're our perfect customers. Like, because most of our customers are the larger investors that do a lot of deals, right? Like, we have a lot of customers that are doing 1,000 properties a year kind of thing. And, we certainly attract the newbies too, but we're more geared towards the higher end folks. You're really hard to find. Like, there's no list of guys like you.
I'm well known amongst the hedge fund community, really boring bankers. And so I've gone to a lot of the conferences like 5 Star and a lot of those and tax lien conference. And so there's like an investor community that's out there, but that's a different community. Than say like the YouTube community, where there's guys out there that, look great, smell great, and you think they're worth $50 million, and, they're making money off the YouTube revenue. Nothing wrong with that. I think that's wonderful. And do a flip a year or something like that. And I'm not saying I'm any better than that. I'm just saying that there's 2 types of people in the business. There's ones that actually send the wire and ones that don't. And the ones that have the ability to send the wire, they're not public figures.
They're usually not on Facebook and they're, I get you.
And they're on super boring sites like LinkedIn and so forth. But what's really cool. So
it's Sean Walker at LinkedIn in Utah. So you can find the right Sean Walker, because I'm sure there's more than one.
We'll post the link on our show notes to the correct Sean Walker.
Thanks.
And Sean, I really appreciate you.
Thanks, you guys,
joining us. And
that's a privilege. And I love your product. And when you sat down and did that demo, I wish I would have had that 12 years ago. Would have made all the difference in the world.
Don't you miss microfiche?
Yeah, well, we did. Yeah. So.
I actually think like there should be a prerequisite before anybody uses our product, that they go to the county and pull a document on microfiche, right? And then go to the clerk and ask for a copy of it and pay the $35 for the copy of that one document, right? Or spend the 20 minutes writing out all the fields from it. Like, that should be a prerequisite to the people who are like, public records are free. I'm like,
ordering a property card from Kentucky. Here's the last thing I'll give you, why this is such a great product. We bought a small tax lien portfolio in Kentucky, and some of the counties there aren't even on microfiche. And this would have been about 2012. Maybe they've upgraded now, but they have index cards in file folders. And so they're 4x6 and they call it a property card. And for $3.50, you can order the property card. Now, not in the main counties like Lexington, some of the bigger towns, but in the very rural areas where we had some of these tax lien certificates, we wanted to get information about the property, especially when we go to foreclose on it. And we had to order these and then wait a couple of weeks and you get your property card. And so, things have come a long way since then.
Crazy business. People don't have no idea what it is that goes into it. Yeah. Well, thank you, Sean. Really appreciate having you.
Thanks, you guys. Been a privilege to be here.
Thank you for listening to the Data Driven Real Estate Podcast. You can find show notes and links to some of the resources mentioned in the show at datadrivenrealestate.com. Click that Join the Community, and you'll be forwarded to the Property Radar community where you can ask questions about the current show and even see upcoming guests and ask questions there. We'd love to engage with you in the community, so check it out. Please don't forget to like, favorite, subscribe, and share on your favorite platform where you're listening to the show. It helps us out a great deal. Thanks for listening, and we'll see you next week.